making money in the market is less maths and more psychology. This is why if you see last 20 years, twice the Nobel Prize in economics has been given to people who study human psychology. I often remind people that when you say be greedy when others are fearful, be fearful when others are greedy, the important words are not greed and fear. The important word is others. Because the brownie is for being...
What is your portfolio looking like today as we speak?
Give or take 50-50 plus minus 5%.
50% equity, 50% real estate, which is sort of like kryptonite for your industry, saying that, hey, don't put in real estate, put here in the markets. So why do you have such a different investing strategy?
Why I speak about buying a house, it's the only asset for which a youngster can get finance. Because there are cons also, it's not just pros.
Right.
See, what is the cons in this? If there is a spring which is 10 centimeters, you compress it 50%, it will become 5 centimeters. If you release it, how much will it recoil? At least it will recoil 100%, right?
Correct, yeah.
That's the correct visualization. Because when stock prices fall, there is a limit to how much it can fall.
See, I understand in the stock market it's easy to understand when it's a good time to invest, when the market corrects. In real estate, how do I know that this is a good time to invest in real estate?
In today's episode of the 1% Club show, we sit down with Aashish Sommaiyaa, CEO of WhiteOak Capital and a veteran with 20 years of experience in India's mutual fund industry. After working at ICICI Prudential Mutual Fund, Sommaiyaa became the youngest CEO at Motilal Oswal AMC. Today, Aashish is one of only 45 CEOs leading India's top AMCs, overseeing assets exceeding Rs 73,000 crore. We dive into his journey from managing billions to building WhiteOak, the mindset retail investors need to create wealth, and how India's investing behavior is evolving.
So, what is your expert opinion of the future of India for the next 5 years? Because that is a very good indicator for investors that should I continue to invest in the market?
On a lighter note, I tell people a lot of times that when the markets are booming and when returns are looking great, investors have more vision or longer vision than even the promoter of the company. But when the stock prices are falling and markets are doing badly, forget the future and the vision. People start questioning the past also, like you said. I mean, was that data correct? I mean, who was the auditor? Right. I mean, was it just inventory and receivables or was there actual cash flow in the profit? Right. So, this is all about psychology. This is why if you see last 20 years, twice the Nobel Prize in economics has been given to people who study human psychology. Because making money in the market is less maths and more psychology, right? I mean,
that's a very interesting point, right? Because like you said, I can spend hours and hours looking into the financials of a company and making an investment decision. But what you're saying is that there is more benefit or there is more advantage to understanding human psychology when it comes to investing. Can you go deeper on that?
Yeah, because it's more important to control emotions. See, I can, like you rightly said, I can have the best of analysts or I can myself be a great analyst. But at the first hint of trouble, if I lose all my conviction and start questioning, man, why am I here? Right. I think the best proxy, like I told you spring, the best proxy is a roller coaster. Sharan, you and me, all of us have been on a roller coaster, right? When, just think of it. Now feel this. When a roller coaster is going up and up and up and up, how do you feel?
I feel the fear increasing little bit, or the excitement increasing.
Right?
Excitement increasing,
yeah, I mean,
that I'm going to fall.
I even remember that when a roller coaster is going up, at some point in time, it can't go up further. The gears crank and it pushes you further. Next round of climb begins. At the peak, if you're in Hong Kong Disney, you will see the whole ocean and you will feel, wow, man, great decision. We should come here once in a year, right? You say nice things to your partner or wife or mother or whoever you are with, right? But what happens after that? Like you write there, what happens after that? After that is when, it starts going down. And then what's your emotion? First it was excitement, ecstasy. What is the emotion when it's hurtling down? When it's hurtling down to the same partner, you say, man, I came here because of you. Next time, please don't push me to get onto a roller coaster. I just hope this bloody thing stops. And I get out of it. The moment it stops, I'm going to get out of here. Right? And let's just go for a meal. I'm never coming here again. Correct? So emotions. Like, why to give this example? Because the peak is an extreme. And when it's hurtling down is an extreme. When human beings are exposed to extremes, that is when their emotions get triggered. And when emotions get triggered is when people make mistakes, especially when it comes to finance, investing. So anybody who's a salaried individual, they did not become entrepreneur, they did not start a business because they want a monthly paycheck.
Correct.
So by psychology, intrinsically, you're a fixed income guy. If you are a fixed income guy intrinsically, by profession you are fixed income, your investment should be equity.
Right.
Because that is what gives you growth and upside.
Correct.
In fact, I can argue that people who are entrepreneurs or businessmen whose entire fortunes are linked to the value of the business, which is listed in the exchange and goes up 5% up and down practically every day, they should be putting money in the bank because they are fully exposed.
Correct.
But what happens in the real world? The guy who's fixed income is the one who says, I can't take risk.
Correct.
And the guy who's an entrepreneur, businessman,
Doesn't
he's setting up his third factory. Right?
Right.
So there
and taking loans for that.
And taking loans. So what happens is that people by nature, it's very difficult to balance. People by nature are either risk averse or risk seeking. But I think, when you were mentioning about, I think somewhere I interjected, you were mentioning about the future, of the country. And
Correct.
So look, I am very, very excited. The reason being that people who are 25, 30 years old today, their investment journey and their careers are going to coincide with the phase when India becomes at least a middle class country.
Yeah.
We've been poor and lower middle class up until now. And in the journey of any country, there will always be that phase where maximum number of people are of productive age. Because 15 years back in India, most people were kids.
Right.
And I believe that 30, 35 years later, most people will be older or nearing retirement.
Right.
But next 20, 30 years, what's going to happen is that most people in India will be between 20 and 60 and at the productive age.
Correct.
So in the next few years, it's well known that India will be the biggest consumer force and the biggest labor force.
Now, going back to the question on SIPs, there are two schools of thought here. One school of thought says that no matter what is happening in the market, don't stop your SIPs, because even when the market is not performing well, you are getting your investments at a lower price.
Yeah.
But there's another school of thought which says that, hey, if you do a little bit of effort, you can do proper timing, right? Basically, like if the FIIs are leaving India, right, they're doing it for a certain reason. They're thinking that, okay, Chinese market is more attractive, or because the US bonds are more safer and more return generating than the Indian market. So why will I put in the Indian market? So is the thinking that if you are a amateur investor, just invest and forget. But if you have some time and interest, you can do some research and you can time the assets really well. Maybe not time the stock, but time your asset allocation really well. Like maybe you should have realized that the Indian market was overvalued maybe 4 or 5 months back. Yeah. You should have exited your investments, kept it in cash, or maybe invested in the Chinese market because that was looking very attractive. Yeah. So which school of thought is correct and what would you recommend?
So what happens is that people need to be mindful of base rates. By base rates, what I mean is that if you go India's liberalization 1991-92, so now we are 32, 33 years down the line. In 33 financial years, India's nominal GDP growth is 12.5%. Okay. Say 6.5% growth and 6% inflation, roughly.
Yeah. So basically, if the growth of the Indian economy has been 6%, you need to add inflation on top of it because the relative price has increased.
Yes.
And when you add up those two things, it becomes
12.
What is that called? Real.
Nominal.
That is called nominal.
Nominal. Fine. Nominal minus inflation is real.
Right. Got it.
But so what happens is that if that's the nominal growth, the fact is that for Sensex, Nifty, all these indices which we track, the earnings of their companies is also in that vicinity, 12 to 13% over last 30 years.
Growth of earnings. Earnings means profits.
Profit
growth has been 12-13% of the biggest companies in Nifty and Sensex.
Absolutely right. And the fact is that the price movement of Sensex and Nifty, meaning the growth in the index itself, so GDP growth, profitability, and the stock price, that itself has also compounded about 12%. Plus, these companies, there is 1.5 to 2% dividend per year. So the actual movement of Sensex and Nifty itself is 14%. So what happens is that, if you invest in good mutual funds, you may have got 16, 17, or, somebody says, forget mutual fund, index itself is 14. Why I said base rate means that if you get 14-15%, that's the long period average. That's how it works. That's how it is. But if you saw September 2024, and then we are talking this asset allocation discussion, at the peak, you take 3 years, you take 5 years, you take 10 years, people were sitting on 18%, 20%, So when people get returns much more than past averages, when people get returns much more than what was originally expected or guided for, then they should know that, okay, it's not like I am a star. It's just that, right now,
this frenzy.
There is a frenzy. See, if the long period average is 15, how can you earn more than 15?
Basically, how can you earn more than what the country itself has grown?
Yes. So it will only happen that, look, the long period average is 15, but last 5 years I am earning 20. So at some point in time, it has to go well below 15 for the average to match up, right?
Correct. So this is sort of like the Buffett indicator as well, right? It looks at the ratio of the GDP and the market valuation of the company.
So if next 3, 4, 5 years of GDP growth, corporate performance, if everything is being factored into the market cap, that is when you get much more than the base rates.
So let me ask a question. Let's say I have 10 lakh rupees invested in the stock market.
Yeah.
Now, as per what you are telling me, I've realized that, okay, now the market is looking overvalued. Is the implementation plan to exit that entire 10 lakhs or is it a certain percentage of that 10 lakhs? Because I'm not sure, 100% sure whether I'm good at timing.
Yeah. So timing also, you should never do blatant timing. If you, so the short answer to your question is not if 10 lakhs is your corpus, right? And you started by putting everything into equity. And, suddenly you are finding that, boss, in a matter of 3 years, 10 has become 50, and it's, given you if 10 has become 15, in 3 years, it is up by 50%.
Which means it has been like a 16-17%.
Which is fine. But if say 10 had become 20 in 3 years, right? So it's 25% compounded. It's a very high number. So out of the 20, you at least put 10 into fixed income and let only 10 remain there. Correct? Only then, when the market falls, you will have some available to plow it back.
Makes sense.
Correct? Now, what happens is that it's easier said than done. And that is why Mr. Buffett had to say, be greedy when others are fearful and be fearful when others are greedy.
Right.
Right? He said it for this only. Because what happens when 10 becomes 20, people think all trees go to the sky. It's me, I am a super brilliant guy. It was my decision to put everything into equity. See what a great thing I have done. So when 10 becomes 20, people think, this is how it works. What's the song and dance about? 20 is going to become 30. But it never happens that way. Right? So that's what the whole point is. I often remind people that when you say be greedy when others are fearful, be fearful when others are greedy, the important words are not greed and fear. The important word is others. Because the brownie is for not being part of the others. Now when 10 becomes 20, who will exit? So what happens is that when you have a situation like March 2020, where in 1 month the index falls 40%.
During COVID. If you were not part of the others, you would be investing.
But what was the others doing when COVID came? When COVID came, everybody said, man, this is where it ends. We are all going to become dinosaurs. And, otherwise, why will it fall 40% in 1 month? Because they're only sellers. There's hardly any buyer.
Right.
Why will everybody sell? Because they can't look beyond, like in Hindi, they say, is raat ki subah nahi, meaning that, this is the night where it all ends, I can't see the morning. So when there is a 40% fall, when there is fear on the street, when one should have been greedy, one actually starts believing like the others that this is where it all ends, we are going to become dinosaurs.
What were you feeling like that time when the market corrected by 40% during COVID? What was your thought process?
I can tell you the exact words. On 19th March, just before the market hit a down circuit, I wrote a blog on the website. I wrote a blog. I wrote a letter to all investors and intermediaries, channel partners, that usually in the world or in markets, usually there is a bear case, a bull case, and a base case. Base. Meaning the average, base case. The way the market is currently behaving, there is only the world will come to an end case or the world will not come to an end case. So you decide. Right? Because it actually felt like that. So who will invest amidst that kind of scenario? Only that person who has one small window open in his mind that, look, all of this looks crazy. But what is the lived history of this world? That human beings are pretty much invincible. We haven't been destroyed for ages.
Correct.
So something will come of it. Correct. But in the throes of the frenzy, that's not how people think. People see each other and get more scared. And Sharan, if you understand it, there is maths behind it.
Okay.
See, look at it this way. I'll tell you a very common anecdote. When 100 becomes 50, and you must have seen it on social media, you must have seen people talking about this. Whenever 100 rupees becomes 50, it's down 50%. You know how people scare each other? They say, man, for 100 to become 50, it's down 50%. But to recover, I need 100%.
Right.
How will it go up 100%? That's absolutely the way you scare people.
Right.
You know, I always tell people that how you will react to a situation depends on how you visualize it. So if you visualize that 100 has become 50, it's 50% down, and 50 has become 100, it needs 100%, so it's not going to happen. The correct visualization, like a spring, right now, engineer to engineer, if there is a spring which is 10 centimeters, you compress it 50%, it will become 5 centimeters. If you release it, how much will it recoil?
Maybe slightly more than what it was, like when it recoiled.
Yeah, so maybe because of force, but
Yeah.
at least it will recoil 100%, right?
Correct, yeah.
That's the correct visualization. Because when stock prices fall, stock prices are not it is backed by earnings.
Yeah.
Correct?
So if it falls below their earnings, then it means that it is
there is a limit
undervalued.
to how much it can fall. Because, if a company's earnings per share is 20 rupees and the price is 100, you compress 100 to 80, 60, 50, but the earnings is 20.
Correct.
If I have no reason to believe that earnings is going to become 0, let's say 20 will become 16, 15, 10, but the price which is falling, there is at least some earnings, right? Beyond the point, so a spring becomes valuable when you compress it, because when you compress, a spring stores energy. Correct? So that's the correct visualization. So I never get scared of markets falling unless I genuinely believe that the world is coming to an end. And the history suggests that it's not yet there.
So right now we see a lot of panic with just a 15% correction. But you have lived through 2008 when there was a 60% correction.
2001, 2008, 2020. And 2013 also was quite a crisis. But
right. But the worst was obviously 2007, 2008.
Absolutely.
That was a 60% correction.
Yeah.
So what can you tell us about your learnings during that time, which could pacify people in 2025 when they're seeing a 15% correction?
Yeah.
Because
So
you came from a point where there was 60% correction.
Yes. So, 2020, thanks to you for bringing it up, we covered. Now let's talk 2008. What was my learning in 2008? First of all, US is the 1,000-point gorilla. Every time the US market falls, we all just, in sympathy, we just give up, right? But it needs understanding that in short periods, the global market, the stock market globally, there's a lot of sympathy. In short periods, the market gets correlated. But if you have a slightly longer perspective, their market follows their economic performance, our market follows our economic performance. So biggest learning in 2008 was that just because stock market falls doesn't mean that our economy is going to the dogs. So our market on many days is nervous purely because Nasdaq is falling 3%. Correct? So these are the times when foreigners sell in India for reasons which are beyond India's economic issues. That will create a buying opportunity.
And you're saying that right now that is kind of happening. Right now there's panic in the Indian market because of what's happening in US right now.
It will persist. I think another 3 to 6 months it will persist that way. We will keep yo-yoing based on what is happening there.
Just a sideways.
While our domestic conditions are slowly and steadily improving, we are still dancing to their tunes on many days. I think we will keep dancing to their tunes in the next 3 to 6 months. But ultimately, panic out there will create opportunity out here.
So now let's ask you the $1 million question. What is your portfolio looking like today as we speak?
If you ask me, I am not the ideal investor. I am a highly risk-seeking kind of investor. And people should not do what I do because my portfolio is fully either equities or real estate. There's no third thing.
Okay. So what is your asset allocation looking like today?
As we speak, I would be more in the vicinity of, give or take 50-50, plus minus 5%. 50-50 would be real estate.
50% equity, 50% real estate.
Absolutely.
Which is really contrary to what other, CEOs of AMCs would be doing, right? They're mostly propagating equity investments, but you are someone who is only 50% in equity and 50% in real estate, which is sort of like, kryptonite for your industry, saying that, hey, don't put in real estate, put here in the markets. So why do you have such a different contrarian investing strategy?
So, a couple of things. One is, if you really ask me for me, real estate is also it's a factor of production. It's a bet on the economy. It's not like, it's not like a very safe investment that I look at it really. It is also a derivative, or it is linked to the economy. It is very closely linked to equities. In fact, a lot of people believe that the equity cycle and the real estate cycle are closely correlated. Even just last 2 days, I was reading this news that in last 6 months, when the stock market has been under pressure, real estate velocity has kind of slowed down. People make such statements. But my personal opinion is, 2 or 3 things I need to say. One is that I invest in commercial real estate, for example.
Okay.
Right.
Which is like office spaces and shops and all of that, not like residential flats.
No, I do have residential investment, but the major part of investment in real estate is actually commercial real estate.
So let's say for 1 crore rupees invested in real estate, how much is in residential, how much is in commercial?
Yeah, so if I leave my house, 80% would be commercial only.
Got it.
Yeah, I wouldn't count my house as investment. Other than that, everything is. So I'll tell you why I said commercial. Because Sharan, what happens is that, if I look at, say, retirement planning, correct? By the time, let's say 15, 20 years down the line, sometime if I want to retire, I'll remove the leverage. So how commercial real estate works? You're putting 3 rupees, 3.5 rupees. The bank is putting about 6.5 to 7 rupees, right? I don't need the rent right now, but the rent pays the EMI.
So basically, and plus you only have to put in a small amount of capital from your own end. The remaining amount the bank gives.
You borrow, yes.
And then the rent pays for the EMI. But isn't it risky that what if the rent stops? Like what if the tenant goes away?
Yes, so there are a few risks and there are a few advantages. So the risk clearly is risk of vacancy. So then, you need to see whether it is grade A, where is it located? Are there enough offices out there? Is it Lower Parel or is it Thana or where it is? That matters. So there are those risks. If there is vacancy, then you need to ensure that you have the working capital to kind of pay up for those 2-3 months. So what happens is that when you invest, right, ultimately these are all yield plays, correct? I'm holding a property which is giving me rent. And what is my return? The rent divided by the value of the property.
Correct.
So it's a yield play.
Correct.
Right? Now, obviously, all yields are linked. If the government borrows at 7.5%, then some of these properties should deliver you 8.5, or maybe 9.
Meaning, what you're trying to say is that if the government bonds is giving us 7.5%, real estate interest yield should be more because the government is safer than real
Absolutely.
estate. That's what you're trying to say.
So all yield, everything which is yield based in some ways is priced off, or the floor is the rate at which the government borrows.
And the government, people don't understand this because most people look at it as just fixed deposit. So the government also gives these bonds.
Absolutely.
From which a common man can invest and get interest.
Yes.
And these are called like sovereign bonds.
Yes, Government of India, GSEC or treasuries or whatever we call them. Got it. So let us say if the government bond, 10-year government bond goes to 6.5, then everything, like for example, there's this notion that when yields fall, even equity multiples start to get inflated. So when yields fall, for commercial also the yield will fall. If the yield falls, it means that the property price would actually appreciate because the rent remains the same. So for the rent to remain the same, if the yield has to fall, the price has to
increase,
appreciate.
So now the government borrowings will reduce, right? The interest rates
it's already on the downtrend.
It's already on the downtrend. Meaning you're saying the real estate will spike now.
Commercial real estate
will appreciate because the government yields are reducing, and this is that correlation that we are seeing.
It plays out. See, it's like REITs, InvITs. All these products also work in a similar fashion. So you can just think that instead of buying a real estate investment trust, you can just imagine that a private individual like me is doing my own investment instead of buying a real estate investment trust.
So, but everybody cannot afford buying a commercial space because the minimum ticket size, let's say 3-4 crores.
Yeah.
If somebody cannot do that, what should they do?
Then they should consider investing in a real estate investment trust.
Okay, which is like a mutual fund for real estate.
Absolutely.
Where the minimum investment is like 300 rupees, right?
It's 2 lakh rupees right now, and I think there's some proposal to reduce it or something like that.
Okay, got it. And okay, so that is your real estate side of investments. Now let's come to what you do, which is equity.
Equities.
So what does your equity portfolio look like?
So, like I said, this just to clarify, this real estate is obviously like a retirement plan, right? Because over the number of years, I would repay the borrowing completely and it would just become a rental income. Now, as far as equity is concerned, obviously it's mixed, it's private and public. For public, we have a very clear rule that I invest.
Public
only
means
with
your
listed equities.
Indian stock market.
Yes.
Private means you're investing in startups and companies that are not
equities.
listed yet.
Absolutely.
Yeah.
So when you say equity, it is again half and half. It is half private equity, half public.
Oh,
equity.
really? You're quite risky in that manner.
Yeah. So that is why it started that people should not invest the way I invest.
Okay.
Right? A
Got
lot
it.
of people see when you ask a lot of professionals, they say that okay, I have 65% equity, 35% debt, and I have 10% in liquid for a rainy day. So I have obviously some liquid for a rainy day. Everything else, I think my time horizon is long, is all risk seeking, is all return maximizing. But I think people should generally try to optimize. They should not try to maximize. That's the factual position.
And how do you sort of look at risk management? Like, of course, you have a very aggressive investment strategy, but I'm sure you also are managing risk in some form or the other. So how do you look at risk management for your own personal portfolio?
So, look, if you see, for example, when I talk about the real estate part of it, for instance, I mean, it's not like I'm putting 10 rupees and borrowing 90 rupees. Right. I mean, where we are sitting now, I would be more like 35, 40 rupees would be my capital by now, and 60 rupees would be
Bank's money.
Bank's money, correct? And it is generally, by and large, it is termed to be reasonably safe, except for what you said, vacancy risk, and you're putting in some money. Now, when it comes to equity, for instance, because of the way I've invested, see, when you invest in private equity, correct, you're investing for 8-10 years. And I don't necessarily go invest in startups myself. I invest with funds which I have a respect for, correct? WhiteOak as of yet doesn't manage private equity, which means it has to be somebody else's funds which have a good track record.
Oh, so there are funds which invest in startups and you invest in those funds?
Yes, of
What are
course.
these funds called?
So there could be, so the startup variety is obviously venture funds.
Yeah.
Right.
Do you invest in venture funds?
Yes.
Any notable names that you can disclose? Any VC funds that you're investing
I
in?
don't mind sharing. Say, for example, one of my classmates runs a VC fund. It's called Roots Ventures.
Which ventures?
Roots Ventures.
Roots Ventures.
Yeah,
Okay.
that's a classmate of mine. He runs a fund. I mean, he has a great track record.
Okay. What kind of returns do these VCs generate?
So if you look at a period of say 7 to 8 years, my sense is about 4x, 3 to 4x is what I have experienced.
Wow, really? In over 7 years, they'll 4x your money.
Yeah, I mean, as we speak right now, for example, one of the funds I have invested 4 years back is currently 3x.
And usually these funds have a minimum investment of 1 CR, if I'm not wrong.
1 CR, yes, absolutely. Because all alternate funds have a minimum investment of 1 CR. So typically one would make, say, venture investing. And I have a sound reason why I invest in private equity. So venture investing, or say sometimes, we make, say, late stage, like say just something which is say 24 to 36 months before the IPO, for example.
I've heard a lot about this, that for example, when Swiggy went before IPO, a lot of HNIs and ultra HNI friends of mine had the investment in Swiggy.
Yeah.
And because it was such a obvious thing that it's going to go up because of so much of retail frenzy, they all made a lot of money.
Yeah, so, so see, that is like, taking a bet on something which is kind of hot.
Do you know what is your overall portfolio CAGR over the last 5-10 years? Have you calculated it?
If you take equity, my sense is it would be about 19-20% compounded.
19-20% compound. Got it.
See, I mean, people, if you see 5 years, say 2018-19 onwards, because there was a liquidity event, and I remember 2018-19 onwards. I can't claim that I invested everything at the bottom of 2020. Real estate, I made a lot of investments in 2020 and 2021. So that's why there's different.
So how to know? See, I understand in the stock market, it's easy to understand when it's a good time to invest, when the market corrects. Yeah. You look at the relative valuations and all of that. In real estate, how do I know that this is a good time to invest in real estate because everything is cheap? Because it never feels cheap. Right? So how do you know it?
No, so you're absolutely right. The timing, the location, all of those things really matter. See, I'll give you an example. There's a book called Capital Returns. The book says that which sector do you think will do very well in the times to come? When people invest a lot of capital into a particular sector, it's set up for poor returns because the denominator becomes very, very big and bloated. So in 2020, if you look back and saw which sector had the least amount of capital investment in the previous 10 years, and which sector saw the highest consolidation, that number of players folded up, competition went down, this sector was completely dissed, nobody thought it would ever recover. That was real estate in 2020. So what happens is that when this is how cycles play out. For a long point in time, when nobody looks at a particular sector or a segment, and no capital goes there, in fact capital is being pulled out, then a minor change in numerator results in a big spike in returns.
Perfect, Ashish. Now I think let's do something fun. Let's do a rapid fire round. I'm going to ask you 5 questions. First question is one book that every investor should read.
Yeah, I think there's a book called Investing, The Last Liberal Art by Roger Hackstrom. I think it's a very interesting book.
What's so special about this book?
So this book actually is about multidisciplinary thinking.
Basically, it is explaining investing through other fields of science.
Absolutely.
Not just mathematics. Interesting. What is the biggest myth about creating wealth?
I think people, you said it brilliantly somewhere in the conversation, people think it's math. The only math you need is that if something compounds at 14-15%, it will double in 5 years. That is one piece of math you need.
Okay.
The other piece of math you need is that if something is valued at $100, but it's available to you 5 years down the line, and if the current rate of interest is say 7%, then what is $100 5 years down the line should today be valued at say more like 60 or some such number. So present value, future value, how many years it takes to double an investment. I mean, those are the kind of mathematics you need.
You don't need like complicated mathematics as what people
think. You
think.
Definitely don't need what we studied, derivatives, those kinds of things. You don't really
logarithms.
You don't need that kind of math. You need more, it's more about discipline, not so much about talent.
Got it. My next question is rent a home versus buy a home. What is your go-to option?
Yeah, I've always been in the buy camp. I mean, that's how I have practiced myself.
So, well, I'm on the opposite camp, right? And I wanted to understand why you think that way. And I will pose my question from the lens of a 25-year-old person today.
Sure.
So a 25-year-old person today earning, let's say, 50K per month, 60K per month. That's the average income. Now, the common societal norm is that by the time you turn 30, you should have your home. Right? You're getting married and you have your home.
Yeah.
Now, this person probably barely has, let's say, 10 lakhs of savings.
Yeah.
Now, why would you recommend this person to buy a house at such an early age?
Sure. So, clearly, I'll tell you where was I coming from and what was my personal experience also, I'll tell you.
Sure.
What I've seen is, like, for example, I bought my first house when I was 28, 27 or 28.
Wow.
Right?
Where in Mumbai?
In Mumbai.
How much was the value of the house when you bought it at 26, 27? This was probably 25 years back. 23 years back. It was
in 2004 when I bought it. In 2004, yeah. The value of the house was about 80 lakhs. Now, what happens is that why I speak about buying a house is for 2 reasons. It's the only asset for which a youngster can get finance. Nobody's going to give you money to put money in the stock market.
Correct.
Right? The only asset, it's the only asset where you will get leverage at a young age. What will happen is that if you bought a house at the right place, at the right location, at an appropriate juncture.
At the right time.
At appropriate juncture, meaning time. What will happen is that I have 5-7 lakh rupees of investment because of the contribution and stamp duty registration. If I make, if I have made the correct choice and if the house appreciates, what happens is that 80 lakh can become 1 crore or 1.2 crore or 1.3 crore or whatever over a period of next 5, 6, 7 years. So my 5 lakhs has a chance to become plus the EMIs, okay? Don't just count 5 lakhs. Because when it was 75 lakh rupees of borrowing, I think I was paying some 60,000 rupees of EMI. So bulk of what I was earning, a lot of it was actually going in EMI. Of course, I was giving some money to my mom and of course I was paying EMI, right? So what will happen is that...
you paid a lot, yeah? I mean, 2004, you could afford a 60,000 rupees EMI per month.
Yeah, so in 2004, I must have been earning like, say, 15 lakhs or 14 lakhs or 13 lakhs or something like that.
That is definitely considered a high salary back then?
Yeah, back then it would be... Yeah, I mean, it would be in that vicinity, definitely. 12 lakhs or 13 lakhs or something like that. So what will happen is that if you invest like that, what will happen is that your capital has a chance to really multiply.
Agreed.
And that level of certainty, if you made the right decision, level of certainty is higher than the level of certainty of equity. So it's just that 2 or 3 things. One is it gives you leverage because at a young age, there is no other asset class for which you get leverage. Second, by and large, the rate of interest on that borrowing is lower than the rate of interest which you will get in your SIPs or equity. Third is that if you are ultimately going to buy a house, then better that you get your foot in the door. The other extreme is to say, I'm never going to buy a house and I don't care for all this logic. That's a different thing. Because there are cons also. It's not just pros.
Right.
See, what is the cons in this? You can't dare to leave your job. You can't think of fire. Right? Even before switching a job, you will think, is this stable, unstable? I have to EMI to pay. It ties you down. So there are pros and cons. I understand that.
But what about the current situation? Like you mentioned about you at the age of 26, 27, you were making 15 lakhs per annum, which is like making probably 30, 40 lakhs per annum as per today's value of money. You were making that at the age of 26, 27. And you bought a 80 lakh car house. Today, if I fast forward, a 26, 27-year-old person, let's say optimistic scenario, this person is making 10 lakhs per annum.
Okay.
Right? Today's value of money. The value of a house in the area that you're living in is 2.5 crores, 3 crores, maybe more.
Yeah.
So the math doesn't make sense to me right now.
Yes, of course. So see, you'll have to see 2-3 things. You'll have to see the location. Like see, when I bought a house in Sivri, it was back of beyond. There was no Trans Harbour link and it was full of mills.
So you need to be okay with finding a house in a not
mills,
an attractive place.
So it is all contextual. I don't think, I'm not even saying that necessarily somebody can replicate the same strategy right now. Second is you have to do it at a certain level of earning or at a certain, by then I was already working 5-6 years, right? So you'll have to do it at a certain point in time. Last thing I'll tell you, even before you ask me about this, I'll say one thing truthfully is that I am a reasonably, I'm a risk taker. People should not be doing what I necessarily do. So there's a reason why I have a particular thought process. And I think if you're ultimately never going to buy a house, then I don't think it's worth even bothering about what I'm saying. Eventually, if you're going to buy a house, then some point in time, you got to make this call. That's the point.
My notion is that I would like to buy a house maybe eventually, but then it should not feel like it's a big purchase, right? Because for most people, when they buy a house today, it feels like they've given, everything that they possibly have for this house.
See, you are a rock star. You're an entrepreneur yourself. And I think you will do great and you will buy a house the day you decide to buy it.
Somewhere like in my late 40s, maybe. That's what
because you're an entrepreneur. And I think there's every chance that you will easily buy it. But I was a salaried individual and I'm talking about salaried individuals, right? So somewhere they'll have to make the
so it's like a sense of security for people.
Yeah, some if you see, again, I'm sorry for repeating, but if you're ultimately going to buy a house, then somewhere you have to make the beginning and you have to start thinking that, it's a fast running train. Where is it that I exactly...
No, but the way that the country is evolving and the world is evolving, it becomes also kind of difficult that, hey, is this the city that I want to have the house in for the rest of my life, right? Definitely. Maybe back in the day, that was not even a thought.
Absolutely.
That I don't know where I'm going to end up, right? But today the youth generation is like, I don't know where I'm going to end up.
That's an important point to keep in mind. Right. I agree with you.
Perfect. Ashish, I think this was a fantastic conversation. We try to keep it as simple as possible, I hope, for, the people watching this video. But thank you so much, guys. If you've been watching until so long, it really means that you have focus and interest in finance. So thank you so much for giving us your time, and I'll see you in the next one.